Hey guys, welcome back to Finance Friday, and today we're going to take a look at a defense sector stock called Lockheed Martin. Now, in the past, the defense sector is an area that I tried to stay away from or stayed away from because of some of my, issues surrounding some of the moral and ethical issues in the defense sector. But that has changed a bit given what I've seen happen in the Ukraine. And I see the importance of a strong defense sector as not only as an offensive weapon, but also as a deterrent to aggressors. And so that has changed my thinking a lot on the whole defense sector. And since then, I've decided to take a small position in Lockheed Martin. And today we're going to take a look at why we decided to make that investment using our 10 plus stock investing checklist. All right. So the first thing that attracted me to Lockheed Martin is that this company has been around for quite a while. And looking on the screen above, you see that this has been around for over 20 years, looking at our fast graphs analysis. And the stock has steadily increased over the past 20 years. There's some ups and downs, but for the most part, the stock price has gone up and to the right. And over the past 20 years, I've had a consistent increase in revenues. So the revenue has grown from about 47 billion 10 years ago to now $68 billion. And moving on from there, the profitability has also increased. The profitability has moved from $2.7 billion this time 10 years ago to $6.2 billion now. So almost doubling, more than doubling in profitability. The gross margins are 13% and the operating profit margins are 13%. Not quite the high margins that you would see in some of the tech stocks, for example, but that is understandable given the heavy nature of the industry and the fact that they're actually dealing with hardware as opposed to software. The third thing that we looked at is free cash flow, and the free cash flow has been in the past year or so about 20%, but it is highly variable, and I guess that is somewhat understandable given the nature of the industry, where you have to spend a lot of money in investing in investments, so you could continuously stay ahead of the game. Because in this case, it's quite literally an arms race, and so spending on defense is very important. So I could understand why the free cash flow has been turbulent over the past 10 years. All right. The fourth factor that we look at is, do they reliably pay a dividend? And yes, they do. The dividend has moved from 619 million paid out in dividends to over 7.7 billion in the past 10 years. So you see a quite considerable increase in the dividend paid to investors, and I think that is quite remarkable. Honestly, if I knew as much about the company back then, when I started my investment journey, this would probably have been one of the stocks that I looked at. All right. Now, the next question that we ask ourselves is, how good is the economic moat? And so I would say that economic moat is, it's kind of hard to gauge, because in terms of the large defense contractors, there are only a few. Raytheon, Boeing to an extent has a defense-centered division, and a few others. So there's competition. There's about 4 or 5 major defense contractors based in the US, and there are some others internationally which are growing. So some based in Europe. Turkey, for example, is spending quite a lot in and investing quite a lot in the defense industry. But compared to other sectors, I think the doors or the barriers to entry into this sector is substantial, not insurmountable, but substantial, given the way that defense contractors work, in that your biggest client tends to be governments, and so that puts a natural cap on how many people can enter this space. So I would say that the economic moat is fairly okay. All right. So the next factor that we looked at is looking at the debt. Do they have too much debt? Can they pay all their debtors, or are they at risk of going bankrupt? And from what we see, the current ratio, or the amount of short-term assets versus liabilities, is quite good. It's at 1.4, and the long-term debt ratio is about 80%. So, and most of that is due to payments to employees and that sort of thing. So I guess financing, long-term debts, which I guess in the past made a lot of sense given that debt was so cheap. But what we would have to do is to see how much of that debt is going to become due soon, because as debt rates rise, I'm not sure if it's a fixed payments that they have to make or if they're variable, and that would influence, I guess, how profitable the company will be in the long term. So that's definitely something to look into, the type of debts that are due. All right, the next question that we like to ask ourselves when we considering investing in a company is, how good is the management? And so far they've returned a return of capital employed. They have a return of capital employed of 16.2% to 24% in the past 10 years or so. So within that range, averages out about 20 or so, and that is quite good. That is much higher than the average in the S&P 500. So that suggests that this company's returns are higher than the standard company in the S&P 500. So definitely a bonus looking at the Lockheed Martin. Right. Does the management team own stock? There has been some selling in the past 6 months by the CFO, and I believe the CEO also sold some stock, which isn't always a great sign, but it's somewhat understandable given the sharp increase in the value of the stock. But overall, there has been a 10% increase in the amount of stock owned by insiders in the past 6 months, and so that's a pretty okay sign that, you know, everyone is not abandoning ship just yet. That net there's an increase in the amount of stock that was bought. Right. Next question: am I being diluted? The amount of stock has decreased marginally from 281 million outstanding to 271 million in the past 3 years. So that's a good sign that it's somewhat steady and you're not being diluted as a shareholder due to the company issuing more and more stock. And lastly, and I guess that's probably one of the most important questions as an investor, is, am I buying at a discount? Now, it's possible to buy a great company and pay a bit too much, but it's more forgiving to buy a great company and overpay a bit than it is to buy an okay company and overpay. In this case, I think that Lockheed Martin, I'm not sure that I'll classify them as a great company, but I think that they're a pretty good company from what I've seen thus far. And in terms of paying, am I buying at a discount? As you can see from the fast graphs graph ahead, the black line indicates the stock price and the blue line indicates the normal price to earnings ratio. And as you can see, there were times when the stock price was below, the black line was below the blue line, or the normal price to earnings ratio, like in about 2009, 2010, 2011. But since then, it has gone above it, and it is quite a bit above it right now, which would tend to suggest that it's a bit overpriced. But when you zoom in on the graph, so rather than looking at the entire history of the company, let's say you look at the past 12 years or so, you see that that overvalue is a lot smaller than it looks on the overall chart looking at the entirety of the company. And if you zoom in past 7 years or so, zooming into there now, you see that it decreases even more. So at this time, I won't say that Lockheed Martin is a screaming discount. It's not a discount. It is actually a little bit above its historical P to E ratio. But what I think has going for it is that given the increased spending that governments have pledged and some have even started doing, Germany, for example, I could see that Lockheed Martin has a tailwinds pushing its price higher and its earning potential higher over the next couple of years, given the fact that in the defense industry, production takes quite a while. It takes years to develop, like I believe it's the F-35 fighter jet that Lockheed Martin produces, and even the famous Javelin missile that the Ukrainians have been calling for a lot for in the past couple of months. Production is a slow process. So given the fact that the US has depleted, I won't say depleted, but have donated quite a considerable percentage of their reserves of some of these weapons, it will take a while for them to replenish, and Lockheed Martin will have a lot of they have a lot of time on their hands. It will take quite a while, for them to fulfill all the orders that governments are going to, and have been sending their way. So I think that Lockheed Martin has a lot of demand for their products for the next couple of years, and I could see them being in a position to pass on any increase in costs, in production costs, onto their purchasers, given the demand for like the Javelin missiles, like I said in the past, and the fact that this technology is so revolutionary. I don't think that people are going to skimp when it comes to defense budgets, at least not at this stage. Right? So that is my quick analysis of Lockheed Martin. And of course, this is not investment advice. I'm not telling you to go ahead and buy this company. What I'm just doing is laying a case as to why Lockheed Martin might be a stock to consider investing in. And yeah, so I would encourage you to look into it some more. In particular, look into the whole the debts that are owed by the company and the structure of the debts. That's something that I would encourage you to look into, to understand before you try pulling the trigger. And yeah, if there's any other companies that you would like us to take a look at, feel free to message us, send us an email, WhatsApp, Facebook message, whatever, and we'll take a look at it. And yeah, have a great weekend, guys, and hope to see you next time. Peace.